If you're here for the CE credits from the CFP board, I will email you after this webinar, get your information, submit that. I'm a little bit behind on that, but I will get that caught up and get those submitted. And if any of you want to ask any questions, just put it in the Q&A in the chat, and I'm happy to bring it up towards the end here. So again, thank everybody for being here. My name is Michael Gaia. This webinar is sponsored by Infrastructure Capital. The man himself, Mr. Jay Hatfield, who's he's done well this year and does well a lot of years. So I'll let Jay go from here.
Okay, great. Thanks, Michael. And thanks, everybody, for joining. We're Infrastructure Capital, focused on providing income securities. We're based in Midtown Manhattan, but this is not the view from our office. If you want to come visit us, you can see the real, somewhat mundane view from our office. These are just a quick overview of our funds. We'll talk a little bit more about them later. As you can see, they all offer attractive SEC yields and attractive distribution yields. So that's the yields that I was describing. The SEC yield is the cash coming into the fund. Distribution yield, we do write covered calls. So sometimes for some of the funds, sometimes the distribution yield is a little bit higher. That's covered by covered calls. So we've had very accurate targets in the past. The thing I will say about targets, though, is they're meant to not just be a signal to buy, but also a signal to sell. So we have a 7,000 target for this year. That's working pretty well. We got up close to that number, which is a pretty full valuation, 23 times. We ended the tech earnings season. During earnings season, you get greed. After earnings season, you get fear. So you're seeing a lot of fear in the market around AI bubbles and overbuilding. So we don't think any of that's significant to at least the companies we follow, but it's causing us to pull back from that 7,000 number. I wouldn't sell everything you own because we do have an 8,000 target for next year. That's simply taking 2027 earnings. So if you have a year-end target, so our target's always year-end. So year-end 7,000 is based on next year's earnings or 26 earnings. Year-end 26 on 27 earnings. There's a 13% forecasted growth in earnings. And so that's simply the movement from 7,000 to 8. So in a way, it's almost fine if we pull back a little bit off 7,000, just creates more upside for next year. And there's two bases for our bullishness. Number one, Fed cutting cycle. Definitely want to be long stocks when the Fed's cutting rates and vice versa. Not long, or out of the market like in 22 when they're raising rates. But we do also think that this AI boom is real. You look at the mega companies, they're not in a bubble. They were fully valued, particularly when we hit 7,000. And I'm just going to quickly look up because I keep this live data, what our estimate is for, and this is using PEG ratios, so their PE to growth rate. So it was pretty close to zero when we hit 7,000. Tech has had a much bigger pullback than the market as a whole. So now we see 11% upside on the Mag 8. So at some point, you'll see some buyers come in, we believe, and start to buy these tech stocks again. One of our biggest ideas is the private equity firms. This is something we hold in really all of our funds, almost all of our funds. So that's particularly Apollo and KKR. They have mandatory convertibles, which are preferred. So we do hold them in our preferred funds as well. And we think that there is this unusual situation where two private, pretty small and very low quality auto-related companies filed for bankruptcy and there was fraud. So then there was a notion, sort of the cockroach theory, that credit was imploding. And we just thought that there was no evidence of that. When you listen to the private equity firms, they say, first of all, they deal with higher quality companies that versus ones that banks often deal with. So they have better selection criteria and there's no systemic problem. And that's really proven out to be the case, but has created this opportunity, particularly with these private alternative asset managers. Also, we don't have any recommendations, but BDCs got too cheap. So we think that was a panic. And next year, we do think that the tech stocks are starting to look more attractive now at 11% upside. But there's a lot of other companies like the ones I already mentioned. In small cap side, GNL, we have a small cap fund, SCAP, that have good upside, like 30 or more percent upside, whereas tech's more like 11. So good time to look at rotation, small caps. If you do, we'll talk about fixed income here next. So on the bond market side, we do continue to think there are going to be 3 cuts. The reason for that is not just that we're going to get a new Fed chair and the president's going to jam the Fed, which I'm clear actually that he can even do that, but because it is a 12-member board. So the real bullishness is that inflation is really already contained. It's just not properly measured. You can get this on our website. I think we have a slide in here as well, that you look at real-time inflation. So there's this thing called the internet where you can get information about what's going on with rents. You don't need to do what the BLS does, where they call people and send them surveys, which is 1970s technology. So if you use real-time data, inflation's already contained because housing is actually very low, or pretty close to zero. Shelter is zero. So that should know the measurement by the BLS is about 2 years behind. Just now starting to show that decline. So we should get to 2% inflation by the end of the year, next year. And so the Fed will have ample evidence to cut. So it's not just some political jam job to force rates lower. They really need to be lower. We have another slide later where you'll see that housing and construction are in recession. So it's really imperative that we cut rates. And it's also imperative we stay on the track to cut rates, because if we go off that track, the 10-year will rise, 30-year mortgages will rise, and the housing market will get even weaker. We're expecting it to bounce off the lows, but it'll continue to, we go back close to 7% on 30-year mortgage, then you could have a further decline in housing, which could drag us into recession. Not that likely with tech being so strong. We had been correct all year about the fact that the employment market was going to weaken. We were surprised it took so long. It really already had weakened, and the BLS also can't properly measure that. We do think for anybody who likes fixed income as opposed to equities, that you want to be in the higher risk part of fixed income. So you have in fixed income, you have munis, treasuries, mortgages, investment grade corporate bonds. We think that high yield bonds and preferreds will outperform. And when that happens is when the stock market's relatively strong. Investment grade will outperform in normal, usually when the stock market's weak. It didn't happen in 22, but normally fixed income investment grade will outperform even when the Fed's tightening. But it didn't, because they did it so quickly in 2022 from very high levels. So we're bullish on treasuries. If there's 3 cuts, we'll get the Fed funds down to 275. The 10-year trades almost exactly 100 basis points over the terminal Fed funds rate. So we should get to 375. Not a huge rally in the treasuries. So that's why we think fixed income will actually be better. Higher risk fixed income, so high yield bonds and preferred stocks. And then on the economy, we covered a lot of this. So our CPI, R is already below 2, but they do converge. There's a lag. So that's critical to our whole call, both on stocks and bonds. keep in mind that Keynesianism is more of a political ideology than it is economic, in that it doesn't really fit the historical data. So it totally blew up during the pandemic. Monetarism worked perfectly in terms of predicting inflation. So just because the economy is going to be stronger next year, we're projecting 3% as housing recovers. It doesn't mean we're going to have inflation. Now, just to be clear, though, it's not totally unreasonable to say, oh, well, if the economy is strong, we're going to have more inflation. But the sequencing is like in the late 90s, the Fed was concerned about Y2K, cranked up the money supply. That created unsustainable growth. So unsustainable growth coming from excessive monetary growth does produce inflation. So you have to draw that distinction. Just regular economic growth does not cause inflation. So it's caused by high oil prices. Like in the 70s, we had 2 wars. We also had wage and price controls, which nobody seems to focus on, but that ruined our domestic production. And so the 2 critical indicators, money supply is down year over year, and oil is down. So the chance of a reacceleration of inflation is 0. Tariffs should be ignored. There are sales taxes that go away from inflation in a year. Not to say they're not annoying, and you can see that in the popularity numbers for the president, and that tariffs are very unpopular. We have a great slide on this. The U.S. economy is less cyclical because we have less peaks in housing. Housing caused 12 out of the last 13 recessions. The only one it didn't cause was the 2001 recession. That was a tech bust. But now we have the opposite of that. Well, we have 2 things. One, we have this tech boom, but it's stronger than in the late 90s that it was, because it affects the real economy. And then secondly, the housing sector is very weak, but it came off a lower peak. So it makes the economy less cyclical. And everybody's wringing their hands about the budget deficit. It's important to look at real data. We make our own forecasts. We're forecasting 1.45 trillion next year because of tariffs and strong economic growth. That is a sustainable deficit. It's also, a lot of people like to say, we have 37 trillion of debt outstanding. Well, that's total debt. The Federal Reserve and Social Security hold about 8 trillion. So right now we have 1 times GDP in debt, and it will slowly decline, not fast enough for my taste. But if we get the deficit down to 1.45 trillion, that's about 4.5% of GDP. GDP grows at 5. That means it's sustainable. So this is great data. I haven't seen it from anybody else. This is the reason we say housing's in recession. So investment in residential structures down 0.20 over the last 12 months, and structures down 0.57%, 0.47, sorry. And that makes sense because rates are really high on the 10-year, and Fed funds are really high. But you can see that we do continue to have strong investment in intellectual property, software, and equipment, which can include chip equipment, power equipment. So it's really a tech-driven boom, not boom, but tech-driven economy, such that we didn't get the normal recession you get when the Fed tightens and housing declines. And then we have some other charts here that look better. Okay, so the other thing that, if you watch financial news, which I don't necessarily recommend unless I'm on, but you'll hear everybody wringing their hands about the consumer. Oh my God, the consumer, student loans, their sentiments bad, etc. But if you look at this chart, consumer spending is very, very resilient. It really only drops when there's a tremendous drop in investment. So first investment drops, then there's layoffs, then there's less consumption. But on average, it's 0. And that's because consumers consume. They're like woodchucks who chuck wood. Lower income consumers have to consume to survive. Higher income consumers want to consume. So unless you have mass layoffs, you basically have very resilient spending. So if you want to judge the economic growth, look to the investment sectors. The reason we're projecting 3% next year is that two negative numbers I showed you are very likely to turn positive. Rates are way lower than they were on average through the year. And so that's likely to turn around. That will spur more hiring and more investment, which is a critical part of economic growth. And so 100% put your focus on investment. So the consumer's 2/3 of the economy, but in very low volatility. Investment's 20, but very high volatility. So what should you watch? The high volatility part of it. It's pretty basic, but it seems like very few people seem to understand this based on their predictions. So this is a great chart that demonstrates what I was talking about. So if you go back here to when I was a kid in Palo Alto, Northern California, I remember everybody gloating about their housing gains. We had two peaks here in the early and late 70s. There was inflation going on. And by the way, money supply is growing at 10% a year. And oil prices were skyrocketing. But we got up to 2.5 million homes being built in the early 70s and still got to 2.2 in the late 70s. 83 looks like about 2.3 during right before the great financial crisis, also about 2.3. But in the latest, and of course, the population's at least double relative to 1971, but we have way less peak housing starts, only about 1.7. So this decline from 1.7 to 1.3 is significant, but it's not a crash like you had in 08 or these other enormous declines that all precipitated a recession. And you can also see how housing starts went down a little bit, but then kind of powered through the recession because there was a secular decline in rates. And that recession was solely driven by the dot-com bust, which wasn't that important to the real economy because of the fact that they didn't have data centers and power and all these other, it's pretty much just software and computer engineers. So ended up with a pretty mild recession that time. This is just, if you don't believe our assertion, you can just see every single recession is characterized by these big drops in investment. And you can see that we did have a big drop in the 2001 recession. That was all investments. All tech spending, not housing, but all the other ones were housing related. And even during the pandemic, of course, people stopped building houses and investing, but that was an artificial one. So we usually don't count. There's 14 if you count the 14 recessions post World War II, if you count the pandemic. So this is just graphically. So you can see that if Fed had half a brain, which they don't, they would have realized by just looking at real-time indicators like ours, CPI-R is this blue line, and they would have figured out in the first quarter of 21, when they were squawking about transitory, possibly for political reasons, they would have easily figured out like, oh my God, CPI is at 8. We better tighten rates. But they didn't figure it out until CPI-U started to get up to 6. So that's why this Fed is about 2 years behind and probably the worst Fed since World War II. But you can see our prediction now is quite simple, just that this pattern continues and CPI-U converges with CPI-R because they're using this 2-year lag. So actually a great graphic to show why the Fed's incompetent and why rates will go down next year is because of U converging to R like it always does. The other thing that I mentioned, you can see this very reliable relationship of the 10-year Treasury trading on top 100 basis points over Fed funds. And Fed funds usually trade 75 over inflation. So that's where 375 comes from. So most people you listen to, forecasters or your own forecast, is going to be always, it's tremendous focus on the budget deficit, and other factors. But budget deficit pretty much has run around 5% since Bill Clinton was president. So it's not like new news that we have a budget deficit. So it's mostly driven by Fed policy and implicitly also inflation. So because Fed funds usually stabilize about 75 basis points over the rate of inflation. So just focus on this, not on budget deficit or whatever other factors people are focused on that don't really predict what happens with rates. And by the way, recently rates have ticked up, but the terminal funds rate just went up as well. So that 100 basis points held just by people not understanding that. And this is just more data that validates what we're saying about the spread being very consistent with regard to the terminal rate. If you use Fed funds like right now, it doesn't work because it's going to go down later. And the money supply we use is the monetary base. That's what you should focus on. And wanting to get distorted by movement between treasuries and deposits. So been about 5% negative, so highly deflationary. Nobody seems to care at the Fed because they don't understand monetary policy. But this is a critical leading indicator. If you go back into history, since World War II, there's the only time we've had inflation is when the money supply spikes. Should talk a little bit about our funds. So this is fixed income. The most critical distinction that you can make is between fixed income and equities. Fixed income, you're senior to common, way lower risk than equities, much more likely to continue your dividends and interest. So good way to balance the portfolio out. Have sources of cash if the market's really weak, where you could take some profits on your stock, on your bonds and move it in your stocks and vice versa. So everybody should have some fixed income so you can do that rotation, rebalance. So if you target 20 stocks run up really high, you can sell a little bit of stocks and buy a little bit of bonds. And then within fixed income, I already discussed it, but you have investment grade, then non-investment grade. So BNDS, PFFA, and PFFR mostly strong non-investment grade, but non-investment grade. So they yield 8 to 9%. PFFA is over 9. This is the SEC yield. The NDS yield is just under 8. So we think a better way to be in fixed income, if we're correct about the stock market being strong next year, coming out of this Fed tightening cycle, credit always tightens when we're coming out of a Fed tightening cycle, or in a cutting cycle, say another way. So these are the sectors that you want to be in, the higher yielding ones. Not true if we're going into a Fed tightening cycle like 22. Unfortunately, nothing worked. Not even investment grade bonds worked, but they did outperform high yield. And then talking about our equity funds, AMZA is a pipeline fund. We put it on the left. It does trade right now, at least, like more like fixed income. So it's a low beta. So like today, even it's up when the market's down. It has great yields, 830 yield. And it's typically tax deferred because you get a lot of excess depreciation coming from the pipeline companies. Pipelines are well positioned because of the fact that they're moving natural gas, and AMZ is tilted towards natural gas companies. Great growth story, not well appreciated. So it hasn't been priced in like a lot of AI derivative plays. So we think there's an opportunity there, likely to get good dividend growth because the underliers are growing. And also our borrowing costs are going down. We do borrow money in these three funds, just 20%, the lowest of any fund out there in terms of borrowing. ICAP, a great fund, doing really well this year, beating the S&P equal weight substantially and holding its own against the S&P, which is nearly incredible because it's only about 10% tech stocks. So I had a lot of great ideas in that fund, but also, most importantly, we write very short-term, curated, covered calls, and that's a great business. So we write them on companies that we think are close to their full valuation, where we have a gain. So we don't do the index call writing like JEPI does, which really hurts their returns. And you should look it up on our website, but our returns are dramatically higher than funds like JEPI. And SCAP, one of the few ways to get really good yields over 7 by owning small caps. There is a rotation going on small caps. When the Fed cuts rates, small caps do outperform. It's likely to continue next year. So we would recommend that investors look at diversifying and not just being in tech. I think on a risk-adjusted basis, tech will lag next year. Still might be on an absolute basis higher because it has a risk about double U.S. stock market, but unlikely to beat its risk-adjusted returns. And really just talked about this already. We actively select the securities. Last year we had this big call on investment banks that in Goldman Sachs is up like 105% over a year and a half. So we're picking the stocks. We're writing these very short-term calls. And we have a lot of stocks that do have substantial dividends. We do have a lot of preferreds that have even more substantial dividends. We have AT&T, Philip Morris, some great, and McDonald's, great dividend stocks. And so that's why it's an accomplishment to beat the equal weighted S&P and be competitive with the S&P because we have a lot of the non-tech stocks in this fund. And this just shows that large cap dividend stocks are an attractive asset class to be in. Everybody's hyper-focused on tech. It's important to recognize that tech has done really well since the pandemic, partly because of the pandemic, but over longer periods of time, being diversified does pay off. And SCAP, pretty similar to ICAP, obviously small caps, so less than 10 billion typically. We write a little bit of covered calls on the individual stocks, a little bit of index calls. It's important not to write too many calls. That's what caps out the returns on ETFs like JEPI, where they're writing almost the whole portfolio on the whole index. A lot of dividend stocks. We only have dividend stocks in SCAP, only profitable companies trading at reasonable multiples of growth or PEG ratio. It's true of ICAP as well. We think that's critical. If you pick your own stocks, you should always know what the PEG ratio is. If you're buying Palantir, you're paying 7 times the PEG ratio. You can buy Marvell for less than 1 time the PEG ratio. When you ignore that, like Broadcom, we owned it, sold it when it got over 400, was trading it above two times PEG ratio, and now it's off almost 20% from its highs. So don't ignore valuation. That's what we do with SCAP and ICAP. We can do it for you, but if you're picking your own stocks, make sure that you know what that PEG ratio is. It's an approximation of a discounted cash flow. So it's just like any investment. You don't buy an apartment to rent out where you're going to get a 1% return on your investment if you rent it out. So same thing with stocks. You don't buy stocks where you get de minimis returns by holding their stock and getting their earnings and their growth. So small caps also are attractive long-term asset. Sort of hard to believe because they've underperformed since the pandemic, but they have beaten the S&P 500. So great asset class to include in a diversified portfolio. BNDS we talked about already, but just high yield bonds, infrastructure driven. We like collateral when we buy bonds. You have lower default rates and better recoveries if there is a default. We try not to have defaults, of course. And these are just the disclosures. So with that, Michael, I would open up to you, see if you or anybody else has any questions.
I'm curious if the dollar were to weaken substantially, would that change the inflation outlook in your view?
Well, normally the dollar weakens when you have a very loose monetary policy. So we don't anticipate the dollar weakening. because we don't have a really loose monetary policy. We're just returning to normal. But at the margin, that does affect inflation. The U.S. is a pretty closed economy. It's about 90% or only 10 there's imports. So we don't think it's a critical factor. And with the Fed being so tight like it is now, it's pretty unlikely that the dollar weakens further. The dollar, it's not well appreciated, but it's trading on top of its 30-year average. It kind of got ahead of itself. Everybody thought that Trump was going to blow up the U.S. economy and spend way too much money, or I don't even know exactly what they thought, but the dollar surged to 108, anticipating his inauguration. Then not much happened that would support the dollar at that level. And then it came back to normal. So we're not dollar bearers, but at the margin, that does impact inflation. The main way it impacts it is the weak dollar would argue for higher oil prices, but we're definitely not seeing that. I'm not sure that would really drive oil prices higher. So that insulates it because of the 10% probably, well, some of it is refined products and oil.
Can we talk about AMSA in the context of that with oil? Just talk about how on the pipeline side, oil's price movement might impact the fund?
Right. So it does affect sentiment when oil prices are weak. So MLPs have not done well this year. And but the great thing about MLPs is they don't have any significant commodity exposure. All the companies got rid of almost all their commodity exposure over the last 5 years because MLPs were way more risky and less well structured 5 years ago. So they don't really have any significant commodity risk. I mean, if commodity prices go to zero, like they did during the pandemic, actually negative, that's not good. But the pandemic was very, very unusual because you weren't really allowed to drive, or at least weren't allowed to go anywhere when you drove in certain parts of the country. So driving plummeted, throughput plummeted. But in a normal market, when oil prices come down, then gasoline prices come down, people drive more, there's more throughput, the pipelines make more money. When natural gas prices are weak, or even if they aren't, they're needed for power generation, so throughput continues. So pipelines are way more resilient. And you're seeing that now. It didn't used to be the case because pipeline companies were just as volatile as oil companies. But now they're about half as volatile. So the market's finally recognizing that they really are more toll roads than they are commodity plays. Not to say, though, like I said, if you get extreme moves down and drilling is significantly curtailed, then you do that can affect pipeline cash flow at the margin. But we're nowhere near, have to be well below 50 to see any decline in throughput.
I wonder if you think some of this recent weakness in the Mag 7 and tech in general means we're going to go back to active stock picking as opposed to this kind of passive indexing, which is what's benefited a lot of these Mag 7 names? Absolutely.
It was easy just to buy the S&P and to get really 50% tech because, just the Mag 8's 40. So the total is about 50. So you're basically just buying tech's driving all the market. So we do think stock picking and particularly sector picking, so not being over allocated to tech, will be positive, not just this quarter, which it's already been, but most of next year as well.
I think that's a good place to wrap up this webinar. Appreciate those that attended. Happy holidays, and check out all of Infrastructure Capital's funds. Jay, I will see you later tonight.
Great. Thanks, Michael.
Thank you, everybody. Cheers.